Dividend investing. This is one of the most passive ways to make a lot of money in the stock market. Now consider this, if you currently have money sitting in a bank, chances are you're losing that money. Inflation coupled with APYs or annual percentage yields of around 0.5% mean that $10,000 currently in your bank is losing value every year, accounting for inflation. Well, today I'm going to introduce you to dividend investing and how this is one of the most passive ways to make steady cash in the stock market. I'll also give you my top high dividend safe stocks to invest your money in today. Then we'll wrap up with several dividend investment strategies that will easily double your money. So if this sounds like something you're interested in, do me a favor, hit that like button and please consider subscribing to the channel. On this channel, I teach all things stocks and make weekly videos on topics ranging from how to chart, what to look for on a financial statement, and my top stock picks. So without further ado, let's learn all about dividend investing and the top dividend stocks for 2022. So really quickly, let's go over what a dividend is. So a dividend is a payment that a company makes to share its profits with shareholders. They are paid on a regular basis and are an incentive for investors as they allow them to earn a return from investing in stock. Dividends are paid out to you per share of stock that you own. So let's say that you own 10 shares of company A. If company A pays you $5 in dividends annually per share, you will make $50 that year. Now, there are different ways that you can get paid a dividend. The most common way is a cash dividend, and the company will directly deposit cash into your brokerage account. Companies may also opt to issue stock dividends, so instead of paying cash, they will pay you with additional shares of stock. Another form of dividend are dividend reinvestment programs or DRIPs, and this allows you to reinvest any dividends received back into more shares of company stock for a discount. We can also see preferred dividends, which are payouts given to owners of preferred stock. Now, preferred stock functions more like a bond, and these dividends are usually paid quarterly and are most often fixed. Now, the last form of dividend is a special dividend, and these are just like a cash dividend. The only difference is that sometimes companies will have a little extra cash lying around, so they'll issue a special dividend to redistribute these accumulated profits. So why should you invest in dividend stocks? Simply put, this method of investing is one of the most passive and stable ways to earn income from the stock market. The goal of this is to outpace inflation. In the beginning of this video, I told you how you're actually losing money if you have your money sitting in a bank. Well, with dividends, you not only are invested in stock that has the potential to appreciate, but you also are collecting regular returns on your investment. Taxes can also be a factor in dividend investing. Investors in higher tax brackets are often observed to prefer dividend-paying stocks if their respective area allows for lower or even zero tax on dividends. For example, for those of you living in Hong Kong, you're exempt from taxes on dividend gains, while Slovakians or people in Greece have a lower tax on dividend income. Now, there are a few important things to consider before purchasing a dividend stock. The first is the ex-dividend date, and this is the date on which the dividend eligibility expires. So let's say that the ex-dividend date for a certain stock is September 1st. If you buy the stock on or after that day, you will not receive a dividend. However, for those that buy the stock prior to that date, they will receive the dividend. Now, when you're assessing a dividend stock, it's important to take a look at the numbers of the company. I've gone in depth on this on my beginner's guide, which I'll link above. I highly recommend it, especially if you are new to investing, as this short 30-minute guide will give you everything you need to know to start investing in the stock market. In that guide, I talk all about how to assess a company to determine if it's a good investment, so I definitely recommend checking that one out. But for dividend stocks, you'll also want to compare stocks based on their dividend payment performance. To do this, you can use the dividend yield factor, which measures the dividend as a percentage of the current market price per share. The dividend rate can also be quoted as dividends per share, or DPS, which is the dollar amount that you will receive. Another important metric to look for is the return factor, which accounts for dividends, increases in share price, and other capital gains. Now, before we get into my top dividend stock picks, I want to caution you against just chasing the highest dividend stocks. Although a high dividend may indicate that a company is profitable and is simply redistributing extra income, it could also indicate a business in distress. A high yield may be in place even if a company has struggled recently and simply has not cut its dividend yet. You need to pay really close attention to the dividend history to see if a company has been consistently paying dividends. Also, make sure to take a look at the company's free cash flow, as this can be an indicator on whether or not they are able to make these payments regularly. Alright, now that you've been warned, let's jump into my top high-paying dividend stock picks. So my first recommendation is Philip Morris, or stock ticker PM. This is a tobacco company and is categorized as a SEN stock. Now, for those of you who aren't familiar with a SEN stock, these are shares in a company involved in activities that are considered unethical, such as gambling, adult entertainment, alcohol, and tobacco. So obviously, if ethics play a role in your investment decision making, by all means, please feel free to skip to my next recommendation. But regardless, I feel like this is an undervalued stock that has a lot of really good things going for it, which could not only give you solid returns on your money over the years, but could also contribute to a steadily rising dividend. I mean, we've seen Philip Morris's compounded annual growth rate between 3 and 5%. Now, I know that investing in tobacco companies can sometimes seem like swimming upstream, especially as attention is drawn to tech companies away from dirty stocks. And although the number of smokers is declining, smoking is very highly addictive and prices won't go down because of that. I mean, just look at their free cash. We went from $8 billion in free cash in 2018 to $10.5 billion in 2020. Oh, and for those of you who don't know how I calculated free cash, just go to their cash flow statement and subtract capital expenditure from operating cash flow. This will give you the amount of free cash that is available to be reinvested back into the company. Speaking of free cash, remember how in the beginning of this video we discussed how companies with excessive cash lying around will oftentimes create dividends that will pay their investors back? Well, PM has a solid dividend yield of 5.21% and an annual dividend of $5. That means for every share that you own of PM, you'll be receiving $5 per year in cash. For a stock that has growing amounts of free cash every year, that gives you, as the investor, confidence that this dividend won't go away. In fact, if we look at the dividend history, we can see that they've increased their quarterly payouts every year, going from 85 cents in 2013 to $1.14 in 2017 to $1.25 in 2021. Point being, this is a really solid company with high earnings growth, increases in free cash every year, and a growing dividend. Now, I don't know about you, but I'd rather have my money in a potentially undervalued company whose dividend alone will help me outpace inflation, not to mention that this company also has potential for massive growth over the years. I'm buying shares of this company and holding for at least a decade. This is just one of those companies that is such a solid and low maintenance pick. Honestly, I just check their numbers quarterly, make sure their dividends are still rising, and besides that, I'm just letting my money sit there to make more money for me. Now, my next stock pick is Realty Income, or stock ticker O. I know that a lot of people can't afford rental properties, but real estate investment trust, or REITs, are a workaround. Realty Income is one of the most well-known REITs, and they specialize in retail properties. Some of their clientele include Walgreens, AMC, and FedEx. Now, REITs are a very popular pick for dividend stocks, and for good reason. They're actually required to pay out at least 90% of their taxable income out as dividends to investors. Realty Income has a current dividend yield of 4.16% or $2.95 annually. Now, for 28 years and counting, Realty Income has increased this dividend. Not to mention, their total revenue has been increasing steadily every year as well. Ultimately, this is a steady and very reliable dividend company that will allow you to generate passive income from real estate without outright owning investment property yourself. So lastly, we have the nationwide NASDAQ 100 Risk Managed Income ETF, or stock ticker NUSI. NUSI buys covered calls on the NASDAQ stock that it owns while also buying puts on the NASDAQ 100, which aids in risk management. I love this strategy because we have seen a lot of market volatility recently, and this looks to be a great way to hedge against that. Although this does cut into NUSI's yield, it is a safer long-term bet compared with other high-yield ETFs. NUSI has a really attractive current yield of 7.9%. Now, just like all mutual funds and ETFs, NUSI has an expense ratio which helps to cover the fund's operating expenses. This expense ratio is 0.68%, which is a little above average, but regardless, it is a pretty insignificant number. Now, let's look at several investment strategies that will help you to minimize your risk as a dividend investor. If you're a long-term investor, I recommend using a dividend reinvestment plan, or DRIP. This will enable you to take the dividends you earn and reinvest it back into shares of that company without any extra fees. Now, if you're trying to make daily and weekly money, you have to remember that companies don't have an obligation to pay dividends. That means if a company has to cut expenses, for example, the dividend may be taken away or lessened. However, it's important to diversify your portfolio with various companies that have different levels of risk. One of my favorite strategies is to invest in a dividend-focused exchange-traded fund, or ETF. This would allow you to have a diversified portfolio of dividend stocks that generate passive income. Focusing on really quality companies with a strong history of dividend growth is much safer than buying high dividend yield stocks that may be much riskier. So which dividend stocks are you looking to buy? Let me know down in the comments below. Also, if you found this video helpful, please don't forget to drop a like. Also, make sure to subscribe if you haven't already. On this channel, I'll teach you everything you need to know about investing in the stock market. Anyways, if you made it this far, thank you so much for watching, and I look forward to seeing you in the next video. Peace.